too early to talk about this year, isn't it, Tim? 2020. Can 2020 be a repeat of 2019 in terms of this incredible overall performance?
Well, the quick answer from our perspective is no, but that's not as negative as that one-word answer would suggest. You have to keep in mind 2019's huge performance, as you said, was the best in a decade. But there are a couple of things to consider with it. The first is it was an unusual year. It started at a rock bottom level. And if you go back 15 months as opposed to 12 months, the UK market was flat. The Euro Stoxx was up modest 6%. So you really do have to consider how we started 2019. And as we go into 2020, what we have is a need for earnings to carry the market. 2019 was a revaluation year where we saw PE multiples move up sharply from those extraordinarily low levels. We're now at a basically fair level, and from here we need to see earnings kick in.
Okay.
We see, Europe started the year cheaper than the U.S. In terms of PE. It was also cheaper than the U.S. at the start of 2018, 2017, 2016, 2015. It's always seemingly cheaper than the U.S. Is that going to change this year?
Yeah, Matt, our view is that the reason for the undervaluation on a relative basis is more structural than anything else, and it's not going to go away. As we see it, you're looking at a 13-ish multiple for the UK, a 14.5 multiple for Europe ex the UK, and that compares, as you rightfully note, 18 and change for the U.S. This has to do in part with big sectors in Europe and the U.K., such as financials and energy, being basically just simply cheap sectors on a relative basis. And you've got some significant big weights in the U.S., such as tech, internet, e-commerce, that trade at very high multiples, and they've got significantly bigger weights than what you find here in Europe. That change is not going to go away.
Can the UK reverse its underperformance in 2020 then, Tim? Does that seem a big ask, given we still have substantial uncertainties, particularly towards the end of the year, perhaps?
Yeah, well, our view is it's pragmatically optimistic, I guess I would say. Look at financials, look at energy. Those were the two huge drags in 2018.
Big weights in London.
Big weights in London. We saw negative earnings revisions in both sectors. Now, as we look into 2020, we've already started to see the 10-year to 2-year spread, and you can use many other sort of metrics and think about interest rates starting to tick up in the UK. Some clarity with Brexit, clarity with global economics, U.S.-China trade, for example, should continue to bolster that. If that continues, financials, specifically banks' earnings, will move ahead. Energy. We saw significant negative revisions through the last half of the year. We've seen oil tick up from in the 50s to now into the mid-60s. We're not super bullish on oil prices, but we've seen an awful lot of negativity being discounted now in the energy sector.
If you're bearish, gold has already had quite a run. So maybe not the best place to hide. On the other hand, you've got U.S. Treasury yields that have bounced all the way back to almost 2%. And the yen, you can buy 109 for $1. Where's the best place for bears to put their money?
Notwithstanding our more bullish tilt, Matt, I think you've got to look at a couple of things from a European perspective if you are more negatively inclined. One would be healthcare. That is the sector that screens best from our sector scorecard right now, both from the standpoint of earnings revisions, and it's not too extended on a valuation basis. And from a country perspective, it's Switzerland. And that's a tough call because it is heavily skewed towards staples and healthcare. That's why it has a defensive characteristic. Valuation is extended with Switzerland having done so well last year, but if you want to put your head in the sand, that's still the best place to go.